Hi guys, and welcome back to another instalment of Property Tax TV. I'm joined by my partner Shaz, probably the two best property tax accountants out there, coming together to help you save tax. And following on from last week's instalment, where we talked about kind of what to do when starting a business, and fantastic tips there, and importantly getting your structure right when doing JVs. This week, we're talking about the other side of that, so much later on down the line, and what to do when it comes to exiting your business and some of the options that are available there if you feel like selling all your properties and retiring abroad. So, Shaz, how are you doing?
Very good, thank you, Josh. How are you?
Yeah, I'm very well, thank you very much.
Good.
Yeah, so in terms of when you come to selling your business, kind of what are your initial thoughts? What do you kind of look for, immediately before kind of anything else?
So let's just talk about, let's say, a property developer who's been buying land, obtaining planning or buying land with planning, building houses or flats or property, and then selling them. And so they have a trading business, and they get to a stage where they're now looking to sell. So some of the thoughts that should be going through their mind are that do they want to sell the company, which would mean selling the shares, or do they want to sell the assets? So that's one aspect that they need to be thinking about. Then they should also be thinking about, are they looking to pass down the shares or the business to their children? If so, have their children been involved? If not, do they want to involve their children? How is that going to work? What's that going to look like? Another option or issue they should be thinking about is, do they have team members who are interested in buying the business, and perhaps they can do a management buyout? And another common and popular one is, if they already have their children involved, but the children don't have the money to buy the shares, can they do a purchase of own shares so that the company buys back their shares? So those are some of the things I think people should be thinking about when they're looking to exit or move on. What about you? What are some of your thoughts?
Yeah, absolutely. So I suppose really the key thing is looking at kind of what you want, what you want to do with the company. Do you want to completely get rid of it, or if you're a property company and you've got assets, are you gradually going to sell those down and just draw the money out each year? Certainly, the main thing to look at is whether you are a trading company or an investment company, simply because under each of those, you've got a lot more reliefs that are going to be available for a trading company compared to an investment company. So a property developer like yourself, usually a trading company, unless they've got substantial assets that they've kept that might harper their trading status. Should we run through each of those kind of bit by bit, just to kind of give people an insight as to what's available? A company purchase of own shares, not many people probably know what that is.
Yeah, we can do. Absolutely. But before we get into that, I think it's also important that obviously if somebody is selling their shares, they then need to consider would they qualify for what's now called business asset disposal relief, what used to be called entrepreneur's relief, with a lifetime limit of £1 million. So that's something they should consider. Once they get the cash, they should be thinking about what they intend to do with that, because there are certain HMRC approved schemes like the Enterprise Investment Scheme, which could be of benefit to them in terms of reducing their capital gains tax and also their income tax, and obviously future income. So some of those are additional elements, and of course it's going to be difficult for you and I to cover all of that in a short video, but I think it's important to raise people's awareness so that going forward, A, you and I can cover those items. B, if somebody's looking to sell their business straight away, they can do a bit of research or speak to you or me, and we'll be happy to help them.
Yeah, absolutely. I suppose, touching on kind of entrepreneurs relief, business asset disposal relief, so that's available to trading companies. What is a trading company? So there's a 20% test that gets thrown about. There's nothing there's no kind of, they look at everything on the whole, don't they? It's 20% of turnover, staff resources, balance sheet. What are your thoughts on that? Because it's not just one single test, is it? It's a very subjective view, and we have to look at it on a case by case basis.
Absolutely. So, obviously, every case is based on its facts and merits, and you and I do have an announcement in the very near future where we're going to be bringing something to the community where we're going to cover all of this in a lot more detail. So it will be covered there. But simply speaking, the test is that if 20% or more of a business's turnover, profits, value of assets, time spent in the business is more than 20%, or more than 20% comes from investment, then you lose your trading status. So you need to be careful of that. And with property, of course, as you can appreciate, the 20% assets test is probably one where people may fall foul, or it's quicker to fall foul of, because obviously when the market's going up and the values are going up, they could quite easily breach that particular rule.
Yeah, absolutely. And there are some property strategies that are trading. As you've mentioned, though, it would take, we could spend an hour talking about this and not cover it all, especially once we've thrown in some examples and case studies in there, which are really going to help people understand this and see how it applies to their businesses. But yeah, as you spilt the beans there on something that we're working on, and will be out to benefit the community very soon. We'll kind of keep it quiet for now and move on to the next topic.
That's because we're working hard on all the content and bringing everything together.
Yeah. So in terms of, we'll move away from trading companies and go to investment companies. So, people that have failed the test, they own properties, be it commercial, residential, buy to let, that kind of stuff. Say, for instance, we've got a married couple, they've not got any children, and they're approaching their retirement age. What are their options out of that company?
So they've got a limited company.
Yeah, limited company. Say £1 million worth of property. They probably make 55,000 or so, but they want to get rid of the business. What are their options there?
So again, it depends if they've got children or family members who they want to involve. They could bring them in and introduce them into the business. That's an option. If they want to pass down their business to their children or other family members, they could think about setting up a trust and making their children beneficiaries. That's another option. But if they want to totally get out of that particular business and are saying, we just want to move on, we want the cash, then apart from any employees, if they've got any, and generally speaking, it's safe to assume, although we should never assume, but it's safe to use it as an example, that if somebody's got, let's say, 10 properties, using your example of the 55-year-old couple, they probably won't have any employees apart from themselves. So management buyout probably isn't going to be something that's going to work, in which case they need to be thinking about now, do we want to sell the company as a whole, or do we want to sell each asset individually? And of course, both of those have their own merits, because if you go to a portfolio buyer, they might be more keen to buy the shares of the business because they'll have to pay less stamp duty. It's 0.5%, but that obviously comes with a lot of due diligence. So that's a hurdle that costs quite a bit of money to cross or cover, and then there's loads of questions that need to be answered. So what somebody who's thinking of doing that needs to do is to make sure that they've worked on all their paperwork and they've got all of their ducks in a row, so to speak, and then they get the funds, pay capital gains tax, and do what they like with the money. The other option is to sell each property one by one individually, or sell one or more together, because somebody might not want to buy all of the 10, but somebody may be interested in buying 2 of them. So once they've sold all those properties, they've now got the cash in the bank, and then they need to draw that cash out and pay income tax, because obviously if they liquidate the company, they can't claim entrepreneur's relief anyhow because they never had trading status. But then the other flip side of that, Josh, is of course they might want to get out of property, but they might not be looking to retire. So then they need to be thinking about, okay, what else can we do with these funds? So for example, they might say, well, we were a investment business. Now we've sold all the properties, let's say individually, we've now got, let's say, £1.5 million in the bank. We now want to start lending money to other investors because we understand the marketplace and we understand there's a need for money. So we'll loan that money and charge a certain amount of interest. So it all depends on if they're looking to get out of this business, are they looking to get into a different business, or are they looking to get out totally? So those are some of the things people should be thinking about.
Yeah, absolutely. So I suppose it's really kind of what is it you want to achieve. A fantastic option there is where people kind of, just because they want to sell all their properties, it doesn't mean that they have to close the company down. So a lot of people don't realise that you can have a company sitting there with £1 million cash, or maybe even more once you've paid your taxes, and you can leave it there, can't you? And then there's a whole host of options available. You can draw it down flexibly. If they might look to retire overseas, there's some fantastic tax benefits there, especially around Portugal, where those funds might be able to be extracted tax-free. So it's really
if they become non-resident, and so that's obviously something that people need to think about, and then they need to consider in detail. But generally speaking, what I find is when people kind of sell their business or part of their business, that they want to go on holiday or have a rest, again, depending on their personal attitude and where they are in life, but then they usually want to come back. And what I usually find is if people sell their portfolio, they like to keep most of the cash in the business, and then they quite like becoming investors because part of their journey, they've had other investors investing in their properties or their deals, and then now they want to become the investor so they can help and support other people, and at the same time create a new income stream.
Yeah, absolutely. And even if they wanted to start a trading business, they could use that cash in the company to start a trading business, which they could then later sell on, get the money personally, claim business asset disposal relief. There's a whole host of options additionally available once you look at where you are and seeing how, someone like yourself or me can come along and actually help you plan for tax to make sure you pay the least amount overall.
Yeah, and obviously if they're a trading business, then they also want to look at how they can maybe move some of that money into a pension, let's say a SAS, so that gets more cash out of the business. They get tax relief that goes into their pension pot. If it's a SAS, they can then start buying commercial property with that, or if they don't want to buy commercial property and they want to lend money, they can lend through that particular mechanism. Any interest that they charge isn't going to be taxable because a SAS doesn't pay tax on its income. So that's another possibility, whether they have trading status now or whether they sell their properties, then start doing something else which gets them to trading status, and then they can use their annual allowance for making their pension contributions. And if they haven't made any pension contribution in the last 3 years, for example, but they were part of a pension scheme, they can then they've carried those forward. So that gives them a total of £160,000 per person. So using your example of a husband and wife, they could possibly have 320,000 between them, which is a lot of money to get tax relief on, and then use that as investors or use that to do something else.
Yeah, which is fantastic. When you think about how usually trading profits income, you're going to pay tax on that. Having the ability to be kind of as tax smart as this, it just gives you a lot more money after kind of not paying any tax to help snowball the growth in your property portfolio and your business career, which ultimately means you can build more wealth than you otherwise would.
Yeah, and the beauty about the example that we're talking about is somebody who's looking to sell, say, 10 properties, A, might not be able to sell them all in one go, and B, because it's going to take them time, they can sell properties individually. Yeah. And they'll have to obviously pay corporation tax on the gain. But then if they want to test out lending money to somebody else, they can do it in bits. So rather than selling all 10 properties and then trying it, thinking, you know what, this isn't as good as we thought it was, or we don't enjoy it. But if they sell 1 or 2 properties, and let's say they've got 250 or 300 grand in cash, they can try that with an investor or with a couple of investors, see if they like it. If they do, then they can sell the rest of the properties and go into it fully.
Yeah. Yeah, absolutely. So that's kind of, we've covered there kind of some of the options that are available to people at the later end. But I suppose for this video, we did want to cover kind of, options to close down your business. So what about people that are early on in their kind of business careers, but have just decided that it might be in service accommodation and it's not for them, they've not found the right area? What options there are available to kind of close down the company? I know you can just strike it off. What needs to be done from that side of things?
So are we talking here about somebody who has, let's use your example, who has a serviced accommodation business and is now looking to sell that business, or they were thinking of starting up serviced accommodation, have a company which hasn't traded, is dormant, and they want to strike it off? Which option are we looking at?
Yeah, we'll cover the first one. We'll go for the first one, and then if we've got time, I'm not sure we will. We'll see if we can do the second option, just to add as much value.
Let's do the first one, and then we can do something separately for the second option. So, if they qualify for entrepreneurs relief, then they can sell that, and they qualify as a serviced accommodation business. Then they obviously get certain tax reliefs. The older entrepreneurs relief, now known as business asset disposal relief, they qualify for that as long as they meet the tests and the conditions. So up to £1 million would only be taxed at 10%. So they could do that, or they could sell the assets in the business, including any goodwill that they have, and then they can liquidate the company and still claim entrepreneurs relief, depending on which way they do it. Either way, as long as if it's one individual and they've got £1 million or less, they can then they only have to pay 10% tax, and the income goes into their personal bank account. They can do what they like with it. Something else which they might want to think about, again, depends on how their business is operating. Sometimes what I see, and I'm sure you've seen it too, Josh, either the husband or the wife or a partner, life partner, may have all of the shares, or civil partner may have all of the shares in their name. So they might want to think about, hold on a moment, the business is worth £1.5 million. I can claim entrepreneurs relief on my first million. On the next £500,000, I'll have to pay a higher rate of tax. So how do I now get my husband or my wife or my civil partner into the business so I can use their £1 million limit too? So that's what I would encourage them to start thinking about. How about you? What do you think they should be doing?
Yeah, so certainly, I suppose there are a number of options. A lot of people are using holding companies now as well. So if you've got a holding company that owns the shares in that, and it owns more than 10%, and it's a trading company, serviced accommodation, then all being well, when it's held it for the number of years, then you can actually get rid of it completely tax-free, can't you? So
by
no
claiming
tax to pay on
substantial shareholding exemption,
which is a fantastic relief that's available, or exemption relief, used interchangeably. And the result of that is, if someone sells someone purchases your company for £1 million, your holding company can sell its shares, and essentially it will have that £1 million, pay no tax on that, and that leaves you in a position where you've now got £1 million in your holding company, which you can redeploy into other businesses, purchase assets, and take it from there, which is really fantastic. And that does highlight, what to me, certainly one of the many benefits of having that structure.
In fact, I've just done one of those, in fact, so that works incredibly well. As you say, if somebody has a holding company structure, and if they don't, by the way, they can set that up. Again, it's about thinking of these things ahead of time, and I guess this is probably the most important point, is thinking of things ahead of time, 2, 3, 5 years ahead, and thinking, what do we now need to do to plan for that time, and then get all these things in place. If you don't qualify for business asset disposal relief, look at the tests and the conditions, think, how can I meet those? If they're looking to carry on in a similar type of business and they want to sell this particular business, then obviously setting up a holding company structure to enable them to make that happen. But these things obviously are difficult to do at the 11th hour. So you need to give yourself enough time to plan for these. Because, for example, if you don't qualify for business asset disposal relief, then it's going to take time for you to meet those tests. And you're going to have to give it at least 2 years to meet those tests. So you've got to be thinking about it at least 2.5, 3 years in advance to get everything sorted.
Yeah, and certainly if people haven't got their group structure in place now, like you mentioned, you can set it up afterwards, can't you? For as long as it's easy if you've got a trading business, because it's something called a share for share exchange, isn't it? Which we won't go into the details of that because that's quite complicated. But the end result is
that's my favorite area.
you swap the shares around a little bit, put a holding company in, bish bash bosh. We've got a group structure in place, which means you pay less tax. Yeah, that's certainly something for another video.
Absolutely. That's probably going to be 6 videos by the time we go through the whole thing in detail, but you're right, yes.
Okay, perfect. So, yes, we've been chatting on for kind of just over 20 minutes now, so I suppose we'll wrap things up because there's only so much tax information that people can take in at once. So on this subject, what are your kind of parting comments and what would you want to leave the viewers with, fresh in their minds that they can take away from this video?
So the first one is obviously plan in advance and think about the future, especially if you're thinking about retiring, getting out of the business, passing it down to your children. Start that conversation as early as you can so that you're aware of your options. Secondly, explore all the possible options to see which one works best for you, because there usually is always more than one option. Make sure you look at all of those and see which one works best for you. So those two would be my key takeaways. How about you?
Yeah, absolutely. So yeah, certainly explore all the options and just make sure that you, even possible, start with the end in mind now. So for people that are just starting out in their business career, what do you want? Do you want to retire overseas? Do you want so many different companies? Do you want a trading business, or do you just want your investment business that holds all of your properties? Try and figure out exactly what you want as early as possible, so that from a tax perspective how to purchase it, how to get it set up, so that later on down the line you're in the best possible position and you've not got to worry about it at all. And in addition to that, kind of look at the options available. So do you want to retire in the UK? Do you want to travel the world for 5 to 10 years? Because if you speak to your accountant about this, no one ever thinks to speak to their accountant and say, hang on a minute, I'd quite like to retire in Malta. But having these conversations with your accountant, it enables them to say, hang on a minute, there might be a few tax benefits to that. And then we can feed that all into the kind of planning that we do for you guys, just to make sure that over the long term, you really are paying the least amount of tax. So that'd be my parting comments on that.
Yeah, that's good advice.
Perfect. Well, as always, it's been a pleasure. Thank you very much for watching, guys. And we look forward to seeing you next week. Bye.